If you cannot tell whether a market is in an uptrend or downtrend on whatever time frame you are looking at, you will almost certainly get chopped out if you trade it. Many traders make the mistake of swing trading in all market conditions, but sometimes the markets are too choppy and erratic to trade with any accuracy or effectiveness. The number one rule of successful swing trading is taking positions in the direction of the primary trend, but not anytime, only when the markets are moving and are not consolidating. In this video, you'll discover a reliable indicator you must pay attention to if you want to swing trade with the momentum on your side and avoid consolidating markets. Before we continue, if you are new to the channel, make sure you subscribe, turn on the notification bell, and leave a like to show your support. So I've mentioned earlier about the choppy markets. I'm sure you know them very well. You enter a swing trading position and the price action becomes range bound and is moving sideways. No profits, and the market just goes up and down for days around your entry point. The fact is, 80% of the time the market is choppy, and your job as a trader is to find ways to identify when the market is trending or not. One of the easiest ways to identify whether the market is moving or ranging is by using the Choppiness Index. The Choppiness Index is based on chaos theory and fractal geometry. This indicator basically helps to identify whether the market is choppy, meaning consolidating or trading sideways, or is trending. Unlike many other indicators, the Choppiness Index is a directionless indicator. The value of Choppiness Index ranges between 0 and 100. A high reading in the Choppiness Index usually happens when there is a significant consolidation in the price action. Here's how this simple indicator can help you record better results when swing trading. When the value of the indicator is above 61.8, it means that the market is moving sideways in a choppy, consolidating manner. Usually the trend continues to be sideways as long as the Choppiness Index stays above the 50 line. Pay attention to this example. Look at the Choppiness Index reaching high values and also look at the price action. Nothing but consolidation, sideways moves, and market indecision. So the closer the value is to 100, the higher the choppiness levels. When the value of the indicator is below 38.2, it means that the market is trending. Usually, the stock remains trending as long as the Choppiness Index stays below the mid-50 line. Let's analyze another example. Observe that when the indicator shows lower values, the market is moving nicely. So the closer the value is to 0, the stronger the market is trending. When the value of the indicator is below 25, it could mean that the prevailing trend may come to an end very soon. Take this as a warning sign. This doesn't mean that the price will reverse. It may continue to move nicely, but you should take a closer look at the price action and act accordingly when potential reversals occur. Now let's see a couple of swing trading techniques you could implement using the Choppiness Index. The first swing trading technique involves buying or selling the breakout after high Choppiness Index readings. In swing trading, it is generally believed that extended periods of consolidation, meaning sideways trading, are followed by an extended period of trending, strong directional movement, and vice versa. So, here is how you could trade this. When a stock is trending above the 61.8 level for an extended period of time, this is a sign that the market is practically flat. A valid approach would be to wait for a fallback below the 61.8 level to signal a trend inception. In this case, once the Choppiness Index fell below that level, this coincided with a nice breakout and the price rallied upwards. Take a look at this chart. we have the same pattern, but only downside. Remember that the choppiness index is non-directional, so high readings are traded the same for an uptrend or a downtrend. Here, the indicator breaks below the level after a prolonged period of choppiness, practically giving confirmation that the breakout was valid. Another technique involving the choppiness index is riding the trend when the indicator shows values below 45. So instead of using two levels, we focused on just one. Basically, when the indicator's line stays below the 45 level for a long period, we look for swing opportunities in the direction of the main trend. Don't overcomplicate your trading, focus on price action, support and resistance, and maybe add a moving average for a better understanding of the trend. So, in this chart, we have several buying opportunities when the choppiness index is below 45 and the price is trading above the moving average. Look how easy it is to identify the trend using this indicator. As long as the choppiness is at low levels, your swing positions should be safe. Here are some short opportunities as the price is making consecutive lows and the choppiness index stays below 45 level. Also, the price stayed below the moving average, confirming the downtrend. Remember to always have an exit plan, because this indicator doesn't provide the best exit signals. Another great way to swing trade with the choppiness index is to combine it with a volume. Where there is volume, there is likely something to happen on the market. Volume is an important indicator that can be used to confirm certain price movements. It is always positive to see increasing volume when a stock is advancing. Likewise, it is good to see an increase in volume during a breakout from a consolidation range. So when we combine the choppiness index with the volume, we could have one of the strongest confirmation we need in order to take a trade. So here we have a consolidation phase with sideways price action, relatively low volume, and high choppiness readings. Observe how the volume started to increase, while the price was still in a range. Once the indicator's line crossed below the 61.8 level, the price broke the range and moved upward. The volume confirmed the valid breakout as it increased gradually throughout the move. The same pattern here, but on the downside. Price action was indicating a range, low volume, which starts to increase once the price approaches the support line, the choppiness index at high levels, and the breakout with the volume showing increasing momentum. Remember that the choppiness index doesn't predict future direction. It is simply a measure of current trend status. You could say that it also measures the volatility, but you cannot use it to take trades blindly. The choppiness index is one of the best indicators to evaluate the markets, but price action, support and resistance, and volume should be your main focus. So analyze the market, determine the main trend, have a defined action plan, and after that confirm your bias with the choppiness index. The true strength of this indicator is best displayed when used as a confirmation that a stock is starting to trend or breaking out. Now, if you enjoyed this type of content, make sure you subscribe to our channel, turn on the notifications so you don't miss future uploads, and leave us a like to show your support. Until next time.